All right, today we're going to cut through all the noise in real estate investing. We're going to focus on one single number, a number that tells you what you really want to know. And that number is the cash-on-cash return. Trust me, once you master this, it's going to sharpen every single investment decision you make from here on out.
Look, this is the question, right? It's the one that keeps every real estate investor up at night. Whether you're just starting out or you've been doing this for decades, it cuts through all the complicated spreadsheets and market forecasts and gets right to the heart of what matters most. And lucky for us, there's a metric that's built to answer this exact question.
And that metric is cash-on-cash return. The easiest way to think about it is like your personal cash yield. It's not about the property's total value or what it might be worth down the road. Nope. It's about the cold, hard cash that ends up in your bank account measured against the cold, hard cash that left it in the first place.
So how do we actually get to this number? You might be thinking it's some super complicated formula, but honestly, it's one of the most straightforward calculations in all of real estate finance. Let's just break it down together.
It's really just a simple three-step dance. First, you figure out your annual cash flow. You know, that's the money that's left over after all the bills are paid. Second, you add up your total cash invested, and I mean every single dollar that came out of your pocket to make the deal happen. And finally, you just divide that cash flow by your total investment. That's pretty much it.
And here's the formula in all its simple glory. Annual pre-tax cash flow divided by total cash invested. You know, what I love about this is how personal it is. It's all about your experience as the investor. It's purely measuring the cash that went into your pocket against the cash that came out of it.
Now that bottom number, total cash invested, is absolutely crucial to get right. It's not just your down payment. So many people make that mistake. It's everything, the whole shebang. Think of it like this. Picture a bucket. Every out-of-pocket expense goes into that bucket. Your closing costs, those due diligence fees, any upfront repairs, even the loan fees you paid. If you wrote a check for it to get the deal done, it goes in the bucket. So let's make this real. Let's say your total cash invested, the down payment, the closing costs, everything, came out to $1.5 million. And in that first year, after all expenses, the property generated $150,000 in pure cash flow. You just divide that cash flow by your investment and bam, you've got a 10% cash-on-cash return. Simple, clear, and really, really powerful.
And that simplicity, that clarity, that's exactly why investors, especially the ones focused on generating income, absolutely love this metric. It tells a very specific and a very important story.
So why is it so popular? Well, first off, it's laser-focused on your actual cash yield. Second, it brilliantly shows the power of leverage, using debt. Since you're only measuring the return on your cash, not the bank's, a good loan can just supercharge your returns. It's also fantastic for tracking performance year over year and for comparing two completely different deals side by side.
But, and this is a really big but, as useful as cash-on-cash is, it has some serious blind spots. And if you rely on it alone, well, you could really get led down the wrong path. So you might see that 10% return from our example and think, awesome, this deal is a home run, let's do it. But hold on a second, not so fast. That number is just one piece of a much bigger puzzle. What this metric doesn't tell you is just as important as what it does.
Okay, here's a critical point. Cash-on-cash is completely blind to the future. It has no idea if the property's value is shooting up or tanking. It totally ignores the massive tax benefits real estate can give you, like depreciation. It doesn't give you any credit for building up equity every time you make a mortgage payment. And maybe most important of all, it tells you absolutely nothing about the big payday you hope to get when you eventually sell.
And this is exactly why we have to look at cash-on-cash in the right context. It's not the entire toolkit, it's just one really important tool inside the toolkit.
One of the biggest points of confusion I see is CRE versus cap rate. So let's just clear this up right now. A cap rate is what we call unlevered. That means it pretends financing doesn't exist. It just looks at the property's income versus its total price. Think of it as measuring the asset's raw underlying potential. Cash-on-cash, on the other hand, is levered. It is all about the return on your specific cash investment after factoring in the loan. They tell two different but equally vital stories.
This brings us to what I like to call the investor's analytical trio. The best investors, they don't just use one metric. They use three. You've got cash-on-cash for your annual cash yield. Then there's IRR, the internal rate of return, which calculates your total return over the entire life of the investment. And finally, the equity multiple, which just tells you simply how many times you got your money back. Using all three together gives you that full 360-degree view of a deal.
Okay, so we've covered the what, the why, and the how. Let's wrap things up by putting all this knowledge into action. How do you actually apply this stuff in the real world?
The million-dollar question, isn't it? What number should you actually be aiming for? Well, the honest answer is, it depends. It totally depends on your strategy and the amount of risk you're willing to take on.
Your target COC return is really all about risk and reward. For a super safe, stable, core property, getting a 5 to 8% return could be fantastic. But for a value-add project, one that needs a little work, you'd probably want to see something more in the 8 to 12% range. And for a high-risk, opportunistic deal, like building something from the ground up, you should be targeting 12, 15, maybe even 20% or more to make that risk worth it.
So if there's one thing you take away from all this, let it be this. Never ever fall in love with a single number. The smartest investors always look at the full picture. They use cash on cash for that yearly snapshot, IRR to understand the total return over time, and the equity multiple to see the overall profit. That complete picture is what really leads to a winning investment. So as we finish up, I'm going to leave you with a question to mull over for your own investing. The next time you're looking at a potential deal, remember what cash on cash is telling you. But more importantly, remember what it isn't telling you. Is that immediate first-year cash flow the only thing that matters? Or is it just one piece of a much bigger puzzle for building long-term wealth?